While looking at the history, we get to know about several different economic crises that has gone far away. So in this video, we brings you the list of the top 10 biggest market crashes of all time. Let's get into it. Number 10. 2015-2016 Chinese market crash. After a few years of being viewed in an increasingly favorable light, China's stock market burst on the 12th of June 2015 and fell again on the 27th of July and the 24th of August 2015. Despite the Chinese government attempt to stabilize the market, additional drops occurred on 4th and 7th of January and 14th of June 2016. Chaotic panic selling in July 2015 wiped more than $3 trillion off the value of mainland shares in just 3 weeks, as fear of complete market seizure and systemic financial risks grew across the country. Surprise devaluation of the Chinese yuan on the 11th of August and a weakening outlook for Chinese growth are believed to have been the causes for the crash that also put pressure on other emerging economies. Number 9. The flash crash 2010. On 6 May 2010, the U.S. stock market underwent a crash that lasted approximately 36 minutes, but managed to wipe billions of dollars off the share prices of several big U.S. companies. The decrease occurred at a speed never seen before, but ended up having a very minimal impact on the American economy. With the opening of the market on 6 May 2010, there were general market concerns related to the Greek debt crisis and the UK general election. This led to the beginning of the flash crash at 2:30 p.m. Dow Jones had declined by more than 300 points, while the S&P 500 and Nasdaq Composite were affected too. In the next 5 minutes, Dow Jones had dropped a further 600 points, reaching a loss of nearly 1,000 points for the day. By 3:07 p.m. things were looking better and the market had regained much of the decrease and only closed at 3% lower than it opened. The potential reasons behind the crash vary from fat-fingered trading, a keyboard error in technical trading, to an illegal cyberattack. Number 8. The 2008 financial crisis. We all must remember how 10 years ago Wall Street banks' high-risk trading practices nearly resulted in a collapse of the U.S. economy. Considered to be the worst economic disaster since the Great Depression, the 2008 global financial crisis was fed by deregulation in the financial industry, which allowed banks to engage in hedge fund trading with derivatives. To support the profitable sale of these derivatives, banks then demanded more mortgages and created interest-only loans that subprime borrowers were able to afford. As the interest rates on these new mortgages reset, the Federal Reserve upped the Fed funds rates. Supply outpaced demand and housing prices began to decrease, which made things difficult for homeowners who couldn't meet their mortgage loan obligations, but also couldn't sell their house. The derivatives plummeted in value and banks stopped lending to each other. Lehman Brothers filed for bankruptcy on 15 September 2008. Merrill Lynch, AIG, HBOS, Royal Bank of Scotland, Bradford and Bingley, Fortis, Hypo Real Estate, and Alliance and Leicester, which were all expected to follow, however, were saved by bailouts paid by national governments. Despite this, stock markets across the globe were falling. Number 7. The dot-com bubble burst. In the second half of the 1990s, the commercialization of the Internet excited and inspired many business ideas and hopes for the future of online commerce. More and more Internet-based companies dot-coms were launched, and investors assumed that every company that operates online is going to one day become very profitable. Which unfortunately wasn't the case. Even businesses that were successful were extremely overvalued. As long as a company had the .com suffix after its name, venture capitalists would recklessly invest in it, fully failing to consider traditional fundamentals. The bubble that formed was fueled by overconfidence in the market, speculation, cheap money and easy capital. On 10 March 2000, the Nasdaq index peaked at 5,048.62. Despite the market's peak, however, a few big high-tech companies, such as Dell and Cisco, placed huge sell orders on their stocks, which triggered panic selling among investors. The stock market lost 10% of its value, investment capital began to melt away, and many dot-com companies went out of business in the next few weeks. Within a few months, even internet companies that had reached market capitalization in the hundreds of millions of dollars became worthless. By 2002, the dot-com crash cost investors a whopping $5 trillion. Number 6. The 1998 Asian crash. The Asian crisis of 1998 hit a number of emerging economies in Asia, but also countries such as Russia and Brazil, having an overall impact on the global economy. The Asian crisis began in Thailand in 1997 when foreign investors lost confidence and were concerned that the country's debt was increasing too rapidly. The crisis in Thailand gradually spread to other countries in Asia, with Indonesia, South Korea, Hong Kong, Laos, Malaysia and the Philippines being affected the most. The loss of confidence affected those countries' currencies. In the first 6 months, the Indonesian rupiah's value was down by 80%, the Thai baht by over 50%, the South Korean won by nearly 50% and the Malaysian ringgit by 45%. In the 12 months of the crisis, the economies that were most affected saw a drop in capital inflows of more than $100 billion. Number 5. Black Monday 1987. On 19 October 1987, stock markets around the world suffered one of their worst days in history, known today as Black Monday. Following a long-running rally, the crash began in Asia, intensified in London and culminated with the Dow Jones Industrial Average down a 22.6% for the day, the worst day in the Dow history, in percentage terms. Black Monday is remembered as the first crash of the modern financial system because it was exacerbated by newfangled computerized trading. The theories behind the reasons for the crash vary from a slowdown in the U.S. economy, a drop in oil prices and escalating tensions between the U.S. and Iran. By the end of the month, stock markets had dropped in Hong Kong 45.5%, Australia 41.8%, Spain 31%, the United Kingdom 26.45%, the United States 22.68%, and Canada 22.5%. Unlike the 1929 market crash, however, Black Monday didn't result in an economic recession. Number 4. The Wall Street crash of 1929. On 29 October 1929, now known as Black Tuesday, share prices on the New York Stock Exchange collapsed, an event that was not the sole cause of the Great Depression in the 1930s, but something that definitely contributed to it, accelerating the global economic collapse that followed after the historic day. In September and early October, stock prices began to slowly drop. On 21 October, panic selling began and culminated on 24th, 28th and the fatal 29th of October, when stock prices fully collapsed and a record of 16,410,030 shares were traded on NYSE in one day. Financial giants such as William C. Durant and members of the Rockefeller family attempted to stabilize the market by buying large quantities of stocks to demonstrate their confidence in the market, but this didn't stop the rapid decrease in prices. Because the stock tickers couldn't handle the mammoth volume of trading, they didn't stop running until about 7:45 p.m. During the day, the market had lost $14 billion. The crash remains to this day the biggest and most significant crash in financial market history. Number 3. The Stock Exchange crash of 1873. The Vienna Stock Exchange crash of May 1873, triggered by uncontrolled speculation, caused a massive fall in the value of shares and panic selling. The National Bank was not able to step in and provide support because it didn't have enough reserves available. The crash put an end to economic growth in the monarchy, affected the wealth of bankers and some members of the imperial court and confidants of the emperor, as well as the imperial family itself. It also led to a drop in the number of the Vienna World Exhibition visitors, a large world exposition that was held between May and October 1873 in the Austria-Hungarian capital. Later on, the crash gradually affected the whole of Europe. Number 2. The South Sea Bubble 1711. Another speculation-fueled fever occurred in Europe a few decades after the Tulip Mania, this time in the British Empire. The bubble centered around the fortunes of the South Sea Company, whose purpose was to supply 4,800 slaves per year for 30 years to the Spanish plantations in Central and Southern America. Britain had secured the rights to provide Spanish America with slaves at the Treaty of Utrecht in 1713, and the South Sea Company paid the British government £9,500,000 for the contract, assuming that it could open the door to trading with South America and that the profits from slave trading would be huge. This was met with excitement from investors and resulted in an impressive boom in South Sea stock. The company's shares rose from 128.5 in January 1720 to over 1,000 in August. However, by September the market had crumbled and by December shares were down to 124. And the reason behind the bubble burst? Speculators paid inflated prices for the stock, which eventually led to South Sea's dramatic collapse. The economy was damaged and a large number of investors were completely ruined, but a complete crash was avoided due to the British Empire's prominent economic position and the government's successful attempts to stabilize the financial industry. Number 1. The 1673 tulip craze. In 1593 tulips were first brought to the Netherlands from Turkey and quickly became widely sought after. After some time, tulips contracted a non-fatal tulip-specific mosaic virus, known as the tulip-breaking virus, which started giving the petals multicolor effects of flame-like streaks. The color patterns came in a wide variety, which made the already popular flower even more exotic and unique. Tulips, which were already selling at a premium, grew more and more in popularity and attracted more and more bulb buyers. Prices, especially for bulbs with the virus, rose steadily and soon Dutch people began trading their land, life savings and any other assets they could liquidate to get their hands on more tulip bulbs. The 1673 tulip mania is now known as the first recorded economic bubble. And as it goes in many speculative bubbles, some people decided to sell and crystallize their profits, which resulted in a domino effect of lower and lower prices. Everyone was trying to sell their bulbs, but no one was interested in buying them anymore. The prices were progressively plummeting and everyone was selling despite the losses. With that being said, here we come to the end of our video. I hope you like this video. If so, then don't forget to subscribe to our channel so you never miss any video. See you in the next video. Till then, take care. Thanks for watching.